What if the bond market knows something we don't? Today, we're digging into why Wall Street's top investors are suddenly worried about the economic fallout from the latest government shutdown and what this could mean for your money. Here's the deal. More than a week into the U.S. government's partial shutdown, bond traders are starting to get nervous. And when the bond market gets spooked, it's usually worth paying attention. But why are bonds, which are often seen as rock solid and boring, flashing warning signs now? First, let's break down what's happening. The U.S. government has partially shut down because lawmakers couldn't agree on a new spending bill by the October 1st deadline. While some parts of the government are still running, many federal agencies have either reduced their services or closed altogether. That means thousands of workers aren't getting paid, and critical government functions, from park maintenance to data collection, are on pause. Here's where bonds come in. U.S. Treasury bonds are basically IOUs from the government. Investors buy them because they're considered one of the safest investments in the world. But when the government's ability to pay or even operate comes into question, investors start to worry. So what are we seeing in the bond market? Yields on short-term Treasury bills have ticked up. Remember, when yields go up, prices go down. That's a sign that traders see more risk in the near term. Likely because they're unsure how long the shutdown will last or what shape the economy will be in once it's over. Let's put this in context. During past shutdowns, the economic impact has often been temporary, but the longer a shutdown drags on, the bigger the risk it poses. According to the Congressional Budget Office, a previous 35-day shutdown cost the U.S. economy about $11 billion, with some of those losses never recovered. That's not just a number on a spreadsheet. It means slower growth, lost wages, and less money circulating through the economy. But there's another layer here. The bond market isn't just reacting to the shutdown itself, it's also factoring in the possibility of a debt ceiling standoff. If Congress can't agree to raise the ceiling, the government could eventually default on its obligations. That's the kind of risk that sends shockwaves through global markets. Now let's zoom out. When bond traders get jittery, it often spills over into other parts of the financial world. Higher borrowing costs for the government can lead to higher rates on everything from mortgages to business loans. That can slow down consumer spending and investment just when the economy needs a boost. On the flip side, if lawmakers resolve the shutdown quickly, markets could bounce right back. We've seen that happen before too, but the current anxiety suggests traders aren't so sure a quick fix is coming. So what does all this mean for everyday investors? For one, it's a reminder that government policy can have real, immediate effects on your portfolio, even if you never own a single Treasury bond. It also shows why it's important to pay attention to the bond market, not just the stock market. Sometimes bonds send signals about the economy before stocks even notice. If you found this breakdown helpful, make sure to like, comment, and subscribe for more straight talk on finance. And here's a question to think about. Will this shutdown be just another blip, or is it a warning sign of deeper challenges ahead? Let's keep the conversation going.